This is Kyle Hunter, aka the Dividend Hunter. Welcome back to the channel here. We're going to talk about another dividend stock. This is one that I added to my portfolio here recently, and one that I think is worthy of taking a look at here as we go forward. Scott's Miracle-Gro company, ticker symbol SMG. Another dip here today, but let's take a look at the year-to-date chart. Was up in the 160s in January. Here we are 4 months later. It's 94.57. The stock has really been hit pretty significantly. You see a nice run during the pandemic and then has really fallen off drastically in recent months. So SMG, certainly things have gone worse for Scott's Miracle-Gro, especially when you look at the comparisons to last year. But let's see if it looks justified or not. Just some quick look here. The yield now 2.75% for Scott's Miracle-Gro. The Simply Safe dividend safety score is 70, which is pretty solid. The 5-year CAGR is 6.1%. Price to earnings ratio 12.4. The industry average is 16.4. The payout ratio is 36%. Both Morningstar and CFRA rate the stock at 4 stars and have a target of $140 on it. That might even be a little bit too high, to be honest, but we know how sometimes they're a bit slow in changing their price targets. But here we are at 94.57. We're long-term dividend investors. Let's take a look at this one with a couple really good platforms. First, Simply Safe Dividends. The most recent dividend growth was 6.5%. 70, the safety score, which is safe. This one's a little bit higher beta than some dividend stocks, so there will be some swings in it. I'm in this for the long term, so I'm not too worried about the swings. The things that stand out to me about Scott's, it looks like it could be undervalued. The timeliness here, looking at Simply Safe Dividends. The forward PE ratio right now is the lowest it's been here in the last 5 years. And, the average for them has been significantly higher than this, 20.5. Now we're down to 12.4. I think it's just tough comparisons from a year ago. So I think this is a little bit overdone. The payout ratio of 36%, earnings per share, you see that it does dip from a year ago. And Scott's has been a bit inconsistent. This is not the most consistent chart of earnings growth you'll ever see, which I can agree that that's a bit of a negative here. And I will say the biggest negative for me on the Scott's company is they have a lot of debt. I don't love that. Their net debt to capital is much higher than I would have thought at 0.70. Interest coverage is not too bad at about 7. So this is a company that, to me, their margins are pretty good, but their debt is pretty high compared to what I would like to see. Having said that, the valuation is very good. Let's take a look at Fast Graphs now. Chuck does a great job at Fast Graphs. I grabbed Fast Graphs here a week or so ago after looking at some of his videos and just seeing the tool being really impressive. Here's a 10-year chart with fundamentals. If you went by average price to earnings ratio, you'd come up with a price that's somewhere in the 140s, by the end of next year. If you went with a 15 PE, the price should be at 107, which 15 is definitely lower than it's usually been. Let's look at the forecasting here, which I think is really a fascinating tool here by Fast Graphs. If you look at adjusted operating earnings, you see that this one makes it not look quite as good as some of the others. If you look at the operating cash flow wise, this seems like it should be much higher than it is now. Price up in the 150s. You forecast it out. You're looking at an annualized return here on the average of 85%. Even if you go more pessimistic, go toward the very bottom here at only, let's say 16 times. By the end of 2024 and the 16 times, the annual rate of return would be 30.76%. I don't know about you, but 30.76% sounds tremendous to me, certainly. If you go based on normal multiples, operating cash flow there you see below, free cash flow. Free cash flow has been a little bit noisy here lately, so I don't know how much to read into this one. The diluted earnings, uh, again, just massive difference here. This looks undervalued based on the long term for Scott's Miracle-Gro. The one thing I will say here at the end too as well, Hawthorne segment here is an unknown to me. There are some risk, but possible big upside as well. The EPS dip now has tough comps. Long term, I think they have some solid growth potential. Simply Safe gives it a good picture. Fast Graph, some impressive looks here at valuation. If you look at the long term growth chart, this looks like it's undervalued at this point, guys. So I'm going to be buying SMG here as it dips going forward. Like I said, I have a small position in this one right now. I don't expect this one to be one of my biggest positions. I don't love the fact that it has a lot of debt. But having said that, I think the valuation is good. Ticker symbol SMG will be one I'll be looking to buy as we go forward. Let me know what you think of Scott's down in the comments below. Appreciate the thumbs up that you guys have been giving. I've seen more views here on the videos lately. Certainly appreciate that very much as we try to just go forward and gain some passive income from these dividend growth stocks. Everybody have a great rest of your week. Do subscribe, give this a thumbs up. If you have any questions, drop them in the comments below. And also follow me at Hunt Dividends on Twitter. Until next time, have a great week.